Good evening, everyone. Bitcoin has just plunged below a critical support level, sending shockwaves through the entire cryptocurrency market as investors brace for the Federal Reserve's upcoming policy decision that could reshape the financial landscape. Welcome to Crypto Hub, your premier destination for timely, in-depth analysis of the digital asset space, where we cut through the noise to deliver the facts that matter most to traders, investors, and enthusiasts alike. In a day marked by heightened volatility, Bitcoin, the leading cryptocurrency by market capitalization, has broken decisively below the $62,000 psychological and technical support zone, dipping as low as $61,200 in early trading sessions before attempting a modest recovery that still leaves it vulnerable to further downside pressure. This move comes amid a broader risk-off sentiment sweeping global markets, fueled by persistent inflation concerns, geopolitical tensions, and anticipation surrounding the Federal Reserve's next interest rate announcement. Market participants are on edge, with trading volumes surging as stop-loss orders triggered cascading liquidations across leveraged positions, amplifying the panic. The total crypto market capitalization has shed over $80 billion in the past 24 hours, erasing weeks of gradual gains and reminding everyone of the inherent unpredictability that defines this asset class. At Crypto Hub, we have been closely monitoring these developments, and today we dive deep into what this Bitcoin slide truly means, the technical factors at play, the macroeconomic backdrop influencing the Fed's decisions, and how this could unfold in the coming days and weeks. To understand the gravity of this situation, let's first examine the technical breakdown that has unfolded. Bitcoin had been consolidating within a relatively tight range between $63,500 and $65,000 for several days, building what many analysts viewed as a base for a potential push toward new highs. However, the breach below $62,000 represents a violation of multiple moving averages, including the 50-day and 100-day simple moving averages, which had previously acted as dynamic support. On the daily chart, this drop has formed a bearish engulfing candle pattern, suggesting that sellers have gained the upper hand after a period of indecision. The Relative Strength Index, or RSI, has dipped into oversold territory near 35, indicating that while a short-term bounce could be in the cards, the momentum remains firmly negative. Volume profiles show heavy selling pressure at higher levels, with on-chain data from platforms like Glassnode revealing that long-term holders are beginning to distribute positions, a signal that often precedes deeper corrections. Compounding this technical weakness is the macroeconomic environment, particularly the looming Federal Reserve meeting. Markets are pricing in a 75% probability of a rate pause, but whispers of a potential hawkish surprise have investors nervous. The Fed has been battling inflation that remains stubbornly above its 2% target, with recent CPI data showing core readings still elevated due to sticky services prices and resilient consumer spending. Chair Jerome Powell and his colleagues have emphasized a data-dependent approach, but comments from Fed officials in recent weeks have leaned toward caution, tempering expectations for aggressive rate cuts later this year. This uncertainty has weighed heavily on risk assets, including Bitcoin, which many still view as a speculative play highly sensitive to liquidity conditions. When interest rates remain elevated, the opportunity cost of holding non-yielding assets like cryptocurrencies increases, prompting capital flight towards safer havens such as treasury bonds or even stablecoins within the crypto ecosystem. The panic in the broader crypto market is palpable. Ethereum, the second largest cryptocurrency, has followed Bitcoin's lead, dropping below $2,400 and testing support near its recent lows. Altcoins across the board, from Solana to Cardano and smaller tokens in the DeFi and meme sectors, have experienced even steeper declines, with some shedding 10 to 15% in a single session. This correlation highlights Bitcoin's dominance as the market leader, where its movements dictate the flow of capital throughout the ecosystem. Liquidations on major exchanges like Binance and Bybit have exceeded $450 million, predominantly from long positions, creating a feedback loop of forced selling that exacerbates the downturn. Fear and greed index readings have plummeted into the fear zone, reflecting a sentiment shift from cautious optimism to outright apprehension. At Crypto Hub, we always stress the importance of risk management during these periods, as emotional trading often leads to poor decisions that can wipe out months of progress. Delving deeper into the on-chain metrics, we see a mixed picture that adds nuance to the current panic. Bitcoin's exchange reserves have been declining steadily over the past month, which traditionally signals accumulation by sophisticated investors moving coins into cold storage. However, the recent price action has reversed some of this trend, with a noticeable uptick in transfers to centralized platforms, potentially indicating preparation for further selling or hedging activities. Whale wallets, those holding over 1,000 BTC, have shown relative stability, but smaller retail addresses are displaying increased activity, consistent with panic-driven behavior. Network hash rate remains near all-time highs, suggesting that miners continue to secure the blockchain robustly despite price volatility, though some marginal operations may face pressure if the downturn persists and reduces profitability. Transaction fees have spiked modestly as users rush to move assets amid the uncertainty, underscoring the network's ongoing utility even in bearish conditions. Looking at historical parallels, this latest slide below key support echoes previous episodes in Bitcoin's journey. Recall the sharp corrections in 2022 amid the FTX collapse and aggressive Fed tightening, where Bitcoin ultimately found a bottom around $15,000 before embarking on a multi-year bull run. Similarly, the 2018 bear market saw multiple breakdowns, followed by periods of accumulation that preceded explosive growth. While history does not repeat exactly, it often rhymes, and these patterns remind us that volatility is not a bug, but a feature of emerging asset classes like crypto. The current cycle, post the 2024 halving event, has followed a somewhat similar trajectory to prior cycles, with post-halving consolidation giving way to volatility as external factors exert influence. The upcoming Fed move could serve as a pivotal catalyst, either accelerating the recovery if dovish signals emerge or deepening the correction if the central bank doubles down on its restrictive stance. Beyond the immediate price action, several fundamental factors deserve attention. Institutional adoption continues to grow, with reports of major corporations and investment funds increasing their Bitcoin allocations through ETFs and direct holdings. The approval and success of spot Bitcoin ETFs in previous years have democratized access, bringing billions in inflows, yet these vehicles also introduce new dynamics where traditional market hours and institutional flows can amplify volatility. Regulatory developments around the globe add another layer, with the European Union's MiCA framework providing clarity, while other jurisdictions grapple with balancing innovation and oversight. In the United States, ongoing debates in Congress regarding crypto legislation could influence sentiment, particularly as the presidential election cycle heats up and candidates position themselves on digital assets. The interplay between Bitcoin and traditional finance cannot be overstated. As a potential store of value or inflation hedge, Bitcoin's performance often correlates inversely with the strength of the US dollar. Recent strength in the DXY index has pressured crypto prices, as a stronger dollar makes dollar-denominated assets less attractive to international buyers. Bond yields have also risen, reflecting expectations of prolonged higher rates, further challenging risk appetite. Geopolitical events, including tensions in key regions affecting energy prices and supply chains, contribute to the overall uncertainty that drives safe haven flows away from speculative investments. At Crypto Hub, we believe in providing context that goes beyond simple price charts, helping our audience understand the interconnected web of factors shaping this market. For traders navigating this environment, several strategies warrant consideration. Short-term scalpers might look for oversold bounces using indicators like the stochastic oscillator or Bollinger Bands to time entries, always with tight stop losses given the potential for continued downside. Longer-term investors could view this dip as an accumulation opportunity, particularly if they believe in Bitcoin's long-term scarcity narrative driven by its fixed supply of 21 million coins. Dollar cost averaging remains a prudent approach, reducing the impact of volatility by spreading purchases over time. Diversification into stablecoins or select altcoins with strong fundamentals can provide hedges, though the current environment favors caution over aggressive positioning. Technical analysts are watching the $58,000 to $60,000 zone as a potential major support area where historical buying interest has emerged in past cycles. A failure to hold there could open the door to deeper retracements toward $52,000, while a decisive reclaim of $64,000 would signal a potential reversal and shift in momentum. Community sentiment on social platforms reflects a divide between those calling for capitulation and others maintaining conviction in the bull case. Influential voices in the space have issued warnings about over-leveraged positions while highlighting the resilience of the underlying technology. Educational initiatives around blockchain, decentralized finance, and Web3 continue unabated, suggesting that despite short-term price pain, the ecosystem's development persists. Layer 2 solutions on Ethereum, advancements in Bitcoin's Lightning Network, and innovations in tokenization of real-world assets represent areas of genuine progress that could drive future value regardless of immediate market conditions. As we analyze potential outcomes following the Fed's decision, a dovish pivot could ignite a relief rally, pushing Bitcoin back above key resistance levels and restoring confidence across altcoins. Conversely, a more hawkish tone emphasizing persistent inflation risks might prolong the consolidation phase or even trigger new lows. Economic data releases in the coming days, including employment figures, retail sales, and manufacturing indices, will provide additional clues about the Fed's likely path. Global factors, such as central bank actions in Europe, Asia, and emerging markets, also play a role in shaping cross-border capital flows into crypto. The environmental narrative surrounding Bitcoin mining has evolved positively with increasing adoption of renewable energy sources, countering earlier criticisms and appealing to ESG-conscious investors. This shift could bolster long-term institutional interest as the asset matures. Security enhancements, including better custody solutions and insurance products, further professionalize the space, reducing perceived risks for larger players. Yet challenges remain, including scalability issues, energy consumption debates, and the need for clearer regulatory frameworks that foster innovation without stifling growth. Expanding on the market panic, it's essential to recognize psychological factors at play. Fear of missing out, or FOMO, drove the previous upswing, while fear, uncertainty, and doubt, or FUD, now dominate headlines and social feeds. Media coverage often amplifies extremes, with sensational reports contributing to herd behavior. At Crypto Hub, our commitment is to balanced reporting that empowers viewers with knowledge rather than hype. We encourage thorough due diligence, understanding personal risk tolerance, and avoiding decisions based solely on short-term price movements. Bitcoin's role as digital gold continues to be tested in this environment. Its decentralized nature, censorship resistance, and portability offer unique advantages in an increasingly digitized world, attributes that gain prominence during times of financial stress. The halving mechanism, which reduces new supply issuance, underpins its scarcity thesis, potentially setting the stage for appreciation as demand grows alongside global adoption. Institutional products like futures, options, and structured notes provide sophisticated ways to gain exposure while managing risk through derivatives. To provide even more depth, let's consider sector-specific impacts. The DeFi space has seen total value locked decline alongside prices, though protocols with genuine utility maintain user bases. NFT marketplaces experience reduced activity, reflecting risk aversion in discretionary spending. Gaming and metaverse projects face similar headwinds but continue building toward mainstream integration. Layer 1 competitors to Ethereum and Bitcoin are differentiating through speed, cost, or specialized features, positioning themselves for potential outperformance in the next cycle. Looking ahead, the script for the coming weeks will likely hinge on central bank rhetoric and broader economic indicators. A soft landing scenario for the economy could benefit risk assets, while recession fears might delay recovery. Technological upgrades, such as potential Bitcoin protocol improvements or Ethereum's continued scaling efforts, offer catalysts independent of macro conditions. Community events, conferences, and developer summits foster innovation and collaboration, strengthening the ecosystem's foundation. In synthesizing all these elements, the current Bitcoin slide below key support and ensuing market panic represent a significant but navigable phase in the cryptocurrency journey. While short-term pain is evident, the long-term outlook for those with conviction remains constructive, grounded in technological progress, increasing adoption, and Bitcoin's established position as a premier digital asset. Investors should stay informed, maintain discipline, and view volatility as an opportunity for those prepared with sound strategies. As we conclude this comprehensive update, remember that the crypto market rewards patience and informed decision making. Thank you for joining us here at Crypto Hub, where we deliver professional insights to help you navigate the dynamic world of digital currencies. Stay vigilant, manage your risks wisely, and we look forward to bringing you the latest developments in our next broadcast. Until then, this is Crypto Hub signing off.